Today's hot housing market is one of those peculiar outcrops from the pandemic. Housing supply was already low before COVID-19, but it was further hampered by the lockdowns, which encouraged people to go out and look for new homes, driven by a host of reasons. First of all, to escape the crowded city areas in search of better places to work for those in-home and at-home offices, or just the plain FOMO, and that's the fear of missing out. Home prices nationwide, including distress sales, grew 17.2% in June 2021 compared to June 2020. That's a record amount. And while there's certainly been hot sellers markets in the past, none compare to this frenzy where over 50% of the homes that are sold are selling more than the asking price. So in order to get some insight into what prospective buyers and sellers might expect midsummer and as we head into the fall market, here's what you need to know. This is Kiwi the Coast, your luxury real estate specialist, helping you maximize and sell the value of your coastal home. So let's dive in and explore what this is all about. So the first point is, are home price increases actually slowing down? While a full-on celebration may be just a little premature, prospective home buyers can breathe a sigh of relief because here's what the experts are saying. Prices are beginning to decelerate in some areas as more inventory is becoming available on the market. According to the National Association of Realtors, unsold homes increased 3.3% or 1.25 million housing units from May to June of 2021. Although this increased inventory is not enough to satisfy the current buyer demand, it may give buyers hope and possibly buying leverage with more options to choose from. Mortgage applications have dropped to an 18-month low, and we are seeing some buyer fatigue out there, not to mention some agent fatigue. And sellers are responding to the drop in buyer enthusiasm by making price adjustments downward. Point number two, the buyer behavior out there we're starting to see become less risky. Similar to how the pandemic triggered a sanitizer and toilet paper buying spree, consumers also flocked to the real estate market last year. As demand picked up, interested buyers pulled out all the stops to outbid the competition. This caused all sorts of strange and reckless behavior among the buyers, many of them foregoing contingencies in their purchase contracts that were designed to protect them and their initial deposits, which can amount to thousands of dollars. Some buyers were tapping into their retirement savings, and many buyers were using loans so they could appear as if they were all cash buyers. But this go for broke approach may be declining, or whether it's because inventory is starting to ramp up or prices are starting to flatten, some buyers are realizing they may just be putting too much on the line, and they're trying to take that power position back and renegotiate after they have the homes under contract. And so we are noticing that there's a lot more buyers out there that are tending to proceed with way more caution than they did several months ago. So we're just not seeing the same level of desperation and urgency that there was before, because many of the buyers are looking at the inventory and just deciding that those homes are just not good deals anymore. Point number three, let's look at those mortgage rates and where we expect prices to be in the fall. While history would indicate that fall is when you can get a better deal on real estate, last year ignored all of those trends with enormous sales growth in the fall season. So are we likely to see a repeat of those trends in the latter part of this year? Ralph McLaughlin, Chief Economist and Senior Vice President of Analytics at House Inc., says that demand will go back to its usual cooling off period in the fall, noting the expansion of inventory and the retreating of home prices. It's absolutely likely that price growth will slow through the end of the year, as we've already seen the slowing of that growth from the peak in June of this year. So we expect price growth to moderate to single high digit numbers by December. Also, housing inventory is on a rising trajectory as we see lumber prices easing and the construction of new sawmills here in the US. But housing supply is still a long way from meeting demand. We also expect mortgage rates to increase as we head into the fall and the new year. The mortgage rates on both the 15-year and 30-year mortgages have been sitting at record low averages since last summer, bobbing between the 3 and 2.5% range. So the low rates have only encouraged an already fiery market. So an increase in rates should cool off demand. Point number 4, buyers should not wait to prepare. The best course of action for all you buyers out there who are sitting on the fence is to get your financial house in order now. If you want to wait until an opportunity comes along, you're going to miss out on that deal. It's a good time to work on that credit score, because the better the credit score, the lower the rates, which translates into lower payments and easier qualifications for you. So keep in mind too that as home prices rise, so does the amount that you need for a down payment. And remember that 20% that you got saved for the home last year, you're going to need more this year, so be sure to continue to save. Not only do you need to save for a down payment, you also need those closing costs and reserves in the bank as well. Hey, I hope you found all that information valuable. Don't forget to subscribe to my channel so that you can stay up to date on everything that's happening with inventory, everything that's affecting you and the real estate market. We'll see you on the next video. The Room.